Chapter 8 is all about receivables. First, we're going to talk about the common classes of receivables. The term receivables is any type of money that people owe to us. Businesses owe to us, organizations owe to us. So we say that it's claims against other entities because they owe us money. We're claiming against them that they have to pay us for a service or product. Accounts receivable are what we are used to using most often. Those are expected to be collected within a relatively short period. So 30, 60 days, 1 or 2 months, we call those accounts receivable. Notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued. With an accounts receivable, it's kind of just we trust them, we have an agreement with them, we don't have to have a formal written note for that. But a note receivable, there's actually a formal agreement written to issue that credit that they can pay us later. Other receivables are expected to be collected within 1 year, are classified as current assets. We've talked about current assets and current liabilities before, so any other receivable that's expected to be paid within the year is a current asset. If collection is expected to be longer than that, they are what we call non-current assets, and they're reported under investments. So in theory, we say we're investing in whatever that is because they're going to pay us back in longer than a year with interest. Next, we're going to describe the accounting for uncollectible receivables. Not everybody pays us back. Sometimes we have to realize that we aren't getting money if we extend credit. Companies often sell their receivables to other companies. So what they'll do is we'll say if somebody owes us money, but instead of waiting for them to pay us, we'll sell it to somebody else and get the money now. That's called factoring the receivables, and the buyer of the receivable is called a factor. Regardless of how careful a company is in granting credit, like I said, not all of them are going to be collectible. We write that off to something called bad debt expense, uncollectible accounts expense, or doubtful accounts expense. For our purposes, we're going to use the title bad debts expense. Other companies may use those other titles. There's 2 methods to record uncollectible receivables. We have a direct write-off method, and that's we write it to bad debt expense only when we know that they're not going to pay us back. We've come to a point we've realized that we're not going to get paid. We write it directly off to the bad debt expense account. The allowance method, we estimate how much is going to be uncollectible. We put it into our allowance account, and then we adjust that to debt expense, bad debt expense. So direct write-off goes right into it. With the allowance method, we're preparing and planning ahead to see what we think is going to be uncollectible. We'll discover that later. Third, we're going to talk about the direct write-off method. So we have an example here about uncollectible receivables using the direct write-off method for when we realize that somebody is not going to pay us back. So on May 10th, a $4,200 accounts receivable from D.L. Ross has been determined to be uncollectible. So the easy part about this is the amount. The amount is $4,200. Well, what do we debit and what do we credit? This is the direct write-off method, so that means we are going to write it directly off to our expense account. What type of expense account did we say we were using? Bad debt expense. Then we are going to go ahead and credit our accounts receivable. Why? We're going to get rid of it. It's no longer accounts receivable. We're going to get rid of it and make it a 0 because they're never going to give it to us, and we've transferred that amount to bad debt expense. So our accounts receivable gets credited. We wrote them off. Probably not going to give them credit in the future, and then we wrote it to our bad debt expense. Direct write-off. The amount written off is later collected on November 21st. This entry here shows us what that would do. The first, we have to reinstate the account. So we just reverse what we did last time. We debit our accounts receivable. Okay, they owe us again, and we get rid of that bad debt expense. That expense is no longer there. We do that by crediting it. Then we go ahead and record the receipt of the cash. This is just like entries we've done before. Somebody's paid us back. We receive cash. We get rid of the accounts receivable. So let's do a practice problem of the direct write-off method. Journalize the following transactions using direct write-off directly to bad debt expense. Look at the examples you just did in your notes. First, we received $1,200 from Jay Burke and wrote off the remainder owed of $3,900 as uncollectible. So what we have to do a journal entry to receive part of it in cash, and then we're going to write the other part of it off to bad debt expense. Then we reinstate the account of Jay Burke to receive that $3,900 pay cash in full. Pause, see if you can do the journal entries. Hopefully your first journal entry looks like this. Our accounts receivable for $5,100, we're going to credit to get rid of it. We are receiving cash for part of it and we're writing off the other part. So the part we receive for cash, we debit cash for that amount, and the rest we write off to our bad debt expense. Did you get that correct? Next, we're going to go ahead and reinstate the $3,900. So we're really going to reverse the bad debt expense accounts receivable part of this entry. So accounts receivable, we put $3,900 back into that account. We take it out of the bad debt expense because it's no longer bad debt. Then we collect the cash, debit cash for that amount, and we take it back out of accounts receivable. It seems redundant, but we have to do that in order to keep accurate records. GAAP requires that we do that entry to reverse it out and put it back in. It also makes it easier when you are balancing your amounts to have it step by step as such. That concludes your notes for tonight.